Okay, there you go. I have to unmute. All right. If you have follow-up questions to your business, to your job, whether you're making so much money on your W-2 or even contractor a while ago, we discussed a person from Colombia, and he just got here. He's into refilling station company. That's why we answer so many questions that he has. Jane, thank you for joining. Greg, okay, so we're live on TikTok. Follow me, Chris Y Coco. We're talking about whether it's well planning, accounting, your small business, if you're immigrant, you have LLCs, the 99s partnership, you are S corporations, C corporation. We're answering all those questions. And we're going to go over with the following questions that I bumped into. Although this is kind of advanced, but I'm going to try as simplify the questions as many as possible. So here in the US, when you are making maybe $90,000 and up and more, you will be subject to higher tax bracket at 22% and up. Now, there are means and ways for you to minimize those taxes. That's the reason why we're talking to our client in Florida. How would he be able to minimize those taxes? So, aside the taxation works, if you have a taxable income, the IRS is always giving you a standard deduction. So, Carla, thank you for joining. All right. So they're giving you standard deduction. Then after the deduction, some earned income, they call it tax credits. The next aspect of your income that will lower your taxes would be your tax credits. So this could be if you have a kid, or if you have Tesla, if you have energy efficient credit like solar panel, or even you're taking care of someone, the dependent care credit. So that is what you call after the deductions. There's what you call credits. It can go as far as other type of credits that are far complex, like we have employee retention credit or ERC during COVID situation. Then we also discuss, we have the research and development tax credits, opportunity tax credits, and most of these credits really apply for people that have businesses. That's why it's having a business, you can make the most out of that situation. But four, so I discussed deductions, I discussed the credits. The third one that you can also make the most advantage is if you are a limited liability company. Depending on the structure, whether you're S corp or C corporation, you can also make the most out of that by applying for S corp is usually subject for other deductions. They don't pay self-employment tax. That's the reason why we have people restructure their company as an S corporation. Okay, but on top, that's the reason why entity is also playing a big important role in setting up or getting make the most out of the tax deductions and or tax savings. That's why we review your deductions, we review your credits, we review also your company or entity structure. So if you have questions pertaining to this, please scan the QR code or text our number for free consultation already provided below. Okay. Um, then the other thing that we're discussing right now is we call it different tax sheltered plans. So these are whether you are a company, especially your LLC, you can pay yourself and then also enroll to some of the benefits like 401k. You can also have your group insurance, group term insurance, and then you can also apply for an asset protection. All of these benefits could potentially minimize also your taxable income, because the strategy is for you to park your money where you will be the one gonna get paid as well. Okay, so the more that you know how to strategize your company's structure, your deductions, your credits, and then your tax sheltered product. If you put these four ingredients together, there will be a maximum savings that you can make the most out of, maybe $10,000 and up. Again, this is advanced, and I'm sorry if there are so many technical terms that we're going to use. Feel free to text us if we won't be able to cover every topic, so we could customize and have a one-on-one consultation. All right, what is a 401k? This is a frequently initial investment, because a 401k, it is a retirement savings plan by an employer, sponsored by an employer, that allows employees to save and invest a portion of their paycheck before taxes are taken out. So a classic example of a 401k, you start in a hospital, whether you're a doctor, nurse practitioner, therapist, the maximum contribution on 2024 is $23,000. If your employer contribute, let's say you contribute 5,000 and your employer contribute 50%, which is another maybe, or maybe 100% matching or 50% match, let's say 100%. So you put 5,000 and then you have another 5,000, your employer contributes another 5,000. So and then you made, let's say, 100,000. So instead of you being taxed at a 100,000, there's a 10,000 deduction already out of the 100,000. So you're no longer going to subject to pay taxes based on the 100, but only 90,000. So that's how 401k works. It's an immediate upset on your taxable income in a year-to-year basis, because your 401k, you will use it on your retirement maybe after the age of 59 and a half. So what are the benefits of contributing to a 401k? Again, the benefits includes, there's a tax deferred growth, which means your money can grow between 3.5 to 12%, but you're not being taxed on the growth. Okay, and then also it's a potential employer matching contributions. It's also a way for you to grow your money aside from the bank, matching contributions and automatic payroll deductions, which facilitate consistent savings. It's when you're in America, it's not really how much money you make, but it is how much money you invest and save. But the most important thing on investment and savings, tax should be working with you, not against your income. Okay. So next, second question: what are the benefits? Well, we answered the contribution to 401k. Then how much can you contribute on the 401k annually? For 2024, the contribution limit is $23,000 for individuals under 50 years old. Okay, so if you're under 50, you can contribute up to 23,000. You have, whether you are working for a company with a W-2 or you have your own corporation, you always have this limit up to 23,000. If you are older than 50 years old, then there's it's higher, 30,500. So again, if you're older than 50 years old, 30,500 would be your maximum contribution due to the catch-up contributions. Thank you, Journal, for joining BTW. Please follow and subscribe on my TikTok, Chris White Coco, whatever, you can find me anywhere. Then next question, another question that our client is asking: what is an employer match in a 401k plan? So an employer match is like what I said, is when an employer contributes additional money to an employer 401k account, typically matching the employee's contributions up to a certain percentage of their salary. So why do people, or why do company offer a 401k? Number one, because it's also like a deduction on their end, on their part of their business expenses. Number two, for me as an employer, it also gives client employee retention. So instead of, if you are giving benefits more than the salary or hourly rate of your employee, I need to charge this. Then they're expecting that in the long term they would making more money because they putting contributions and you're also putting the same to their 401k when they retire. So it means that they can stay with you longer. That's why 401k is very popular, especially in hospitals, people making whether you work in a telecom company making $90,000 and above. Then the question, what is the tax consequence? Another question, what are the tax consequence? So is a penalty called 10% to the amount of money that you withdraw from your 401k. That's a 10% early withdrawal penalty. So that is one thing that you may incur if you withdraw the money before 59 and a half years old. That's why we're telling to our clients, when you save and invest, do not think that you're make sure that you're putting money on this investment that you will not use for the next 25 years or more, or even 10 and a half, 10 or 15 years at least, because this is a long term. The money grows because of time. So do not push yourself. Ideally, I ask my clients to at least put 5% of their savings in any investment, 5 to 10%. If you're making $10,000 per month, just put maybe 500. Okay. Do not put all your money in one basket. Oh, I want to be aggressive because my employer is what do you call this? My employer is maximizing, and then eventually you don't have money to pay your travel, you don't have enough money to pay for your education because you put everything in one basket. Okay, so make sure you have enough money. Your income should be, if you have 10,000 of income, by rule of thumb, only 10 to 20% go to savings and investment. The remaining 80% you need to cover the bills. You also have some money to cover your travel, your pleasure, like if you love to travel, and then other emergency fund. That's the reason you need to have an emergency account. Okay. So that's why if you want to know more the rules of budgeting, if you're an immigrant, if you're a business owner, and you're a freelancer making a lot of money with dependents as well, we're here to create a personal financial strategy for you. So how much the other, let's go on with the next question. Okay, so can you take a loan from your 401k? Yes, you can take 401k plans allow participants to take loans, typically up to 50% of the vested account balance or $50,000, whichever is less. If your 401k already has a $100,000, the maximum contribution is only 50%. I mean, the maximum loan that you can have is only up to 50,000, whichever is less, or 50% of the total amount of money that you have on 401k. Would I encourage in taking loan out of the 401k? No, I don't encourage for you guys to take a loan on your 401k. That's the reason there are other options you can have, maybe an asset accumulation, life insurance, where you can borrow money that it's loan money that is not taxable. Because remember, any money that you loan to the your 401k is also taxable. Okay, it's also taxable and then subject to early withdrawal penalty. Okay, now that's most of the questions. We already answered the frequently asked questions for 401k. Now we're going to go over. We're just covering three different tax sheltered accounts or investment accounts. The other one that we're covering is the individual retirement account. This is very popular, called IRA. Again, guys, there are so many products of IRA. We're discussing in general the individual retirement account. But what is an individual retirement account? So an IRA, it is designed to help individuals save for retirement, available in two main types, either traditional and Roth. So what are the difference of traditional and Roth? From Roth IRA, again, the traditional or contributions to a traditional IRA may be tax deductible every year, and earnings grow tax deferred until withdrawal. Whereas Roth IRA contributions are made with after tax dollars, but qualified withdrawals are tax free. Again, let me emphasize, there are two different taxation treatment for traditional IRA and from Roth IRA. So the contributions to traditional IRA, let's say, may be tax deductible every year, and earnings are grow tax deferred until withdrawal. So you're not gonna pay tax to your traditional IRA income or money until you withdraw or you retire. Whereas the Roth IRA, this is already after tax dollars. They remove taxes already from the contribution. So when you withdraw the money, this is tax free. So, but Chris, when can we use both? Where can we use traditional? Where can we use the Roth IRA? Again, number one is knowing what is the contribution limit for the IRA in 2024. The contribution limit now in a traditional IRA is up to, thank you, Conejita, Rising Star, thank you for joining. Please follow us, book your free, type free on our number for free appointment. We're using 515-992-8829. Okay, just type free if you want to know more. Okay, our text number right now is 515-992-6829. We have an issue with our main number. We cannot receive message. We're still, my team is still fixing it. 515-992-8829. Okay, so for the IRA, going back, the traditional contribution limit for the individual retirement account for traditional IRA is 7,000 per year. So when you put 7,000 to your individual retirement account, that will offset also your taxable income. in a year-to-year basis. Or 8,500 when you turn 50 years old and older, the contribution limit is 8,400. So again, if you're making 100,000 and then you put 7,000 or 8,500, you're no longer going to be taxed that 100,000 because 7,000 goes to your individual retirement account. Now, but aside from the maximum contribution per year, there's also an income limit for contributing to the Roth IRA. For 2024, the income limit for single filer, again, the drawback of Roth IRA, you cannot contribute if you're single and making more than $153,000 a year. So that's the contribute total income limit. Now, if you're married, your husband and or your wife, you file together, your income should not exceed at 228,000 for married couples filing jointly. Otherwise, you're not be qualified for Roth IRA. So again, the Roth IRA has contribution limit based on the maximum income that you're receiving every year. If there is contribution limit, if there is an income limit, but can there are cases that like a doctor, he made a lot of money on his entire working career from 20 years old until 65. He doesn't need the money. Is he allowed na to just put all those money there, whether it accumulated $300,000 and he's already 80 years old, he doesn't need the 401k. The question, what is required minimum distribution? Can he just keep his money there? The answer is at the age of 73 years old, and required minimum distribution amount you must withdraw from your traditional IRA at starting at age 73. They will require you to withdraw a minimum, they call it required minimum distribution or the RMD. Thank you, Eduardo, for joining. What happened to my life? Oh, now they start live in TikTok. This is crazy. Let me see violation reason. Now I need to go with my TikTok because I have to appeal. I don't know what their the violation is. Hmm. It says we want people to able to use our platform to learn about ways. This is now because I'm just getting used with TikTok. Somebody reported about scams or frauds. What is this? Is something about different platform. They have their own limitations. But anyways, let me continue with my stream with other platform like Facebook. Okay, we're gonna continue with again, you can watch me on YouTube, LinkedIn, and then Facebook. Now we're talking about required minimum distribution is the amount you must withdraw from your traditional IRA starting age 73. The Roth IRA do not have R&Ds during the owner. So when you put your money in a Roth IRA, there is no income limit on what you're I mean there's no required minimum distributions or withdrawals during the owner's lifetime. The next question, this is also popular, can you contribute to both 401k and IRA? So yes, the individuals can contribute to both 401k and IRA, but this is subject to the respective contributions limits of each account. That's the reason I keep saying it's important for you to communicate with us so we could actually check all your what are the different limitations and how you can make the most out of it so you don't have to pay so many taxes. Okay, so we're gonna go over this product, the Index Universal Life. This is very controversial. I've been part of the Facebook group, and they keep asking, they get scammed, they get that this is not ideal for them. People that offer them the Index Universal Life, uh, they cannot see those people again, and that's what the problem with different financial planners. They get the license, they do it part time, they do have a part time, they take it part time, and but they have the full time investment of their clients. I think as somebody that's taking this career, and I've been a financial planner for years, and then at the same time as a tax business owner for an accounting company, we take pride. I have to give up my job just to really hone my skills on sales and marketing my business, but also learning every now and then and hiring our virtual accountants and partnering up with financial planners. So it really takes time. And people that are in the recruitment company, I mean, yeah, I do understand that leverage is the way to go when you recruit people. You want to use other people's time, or you want to grow through leverage. Leverage is when you're making money not just on 100% of your effort, but you're making money out of other people's effort, other people's resources, other people's money. But I do suggest that if you are trying to consider being a financial planner as a career, please make sure that you commit, and then you build loyalty to your client. Just that, try to go back to your client every 6 months and ask how are they doing with their investment or with their policies. Check their what are the different life stages they're going through. It's important because you don't want your client to regret that they put money to you, to the product, and they entrusted it to you, and you just abandon them because you're focused so much, or maybe you're not focusing so much, you're jumping from one career after the other. So I don't, it's just sad. Okay, just make sure if you're working with your client, educate them, and now if you really have to change your career, please do not abandon them, but reach out to them and then endorse them to your senior accountant or senior account manager so they can take care of the client's investment. Okay, again, uh, I we handle more than 1000 accounts from different walks of life, and it's sad that we are part of this group. They're presenting an index universal life is not primarily it's not an investment primarily. Do not present an IUL as an investment. It is a protection that offers lump sum amount of money to the policyholder, whether the mom or the dad, if something either death happen or disability or chronic illness. Either there's something happen, let's say there's a 1 million policy, this is an instant income replacement. Okay, income replacement if the head of household, the mother or the father, died by accident, or even not even by accident or any cause of death, or even if they get sick that that for them to stop working, there's lump sum amount of money that they can receive maybe in a month to month basis out of the policy that they get. But again, this is not primarily an investment. Okay, so an index universal life, it's a type of permanent life insurance that provides a death benefit and includes a cash value component which earns interest based on the performance of the stock market. A lot of you have index universal life, whole life, term insurance, doesn't matter as long as you have an insurance. It's very important, especially if you have three kids that they're still going to school or they're still young. You need this because we have a client in New Jersey. Last year she was super healthy. She's a nurse practitioner, and then this year she's making roughly $350,000 a year, and then she has three kids. But this year we were surprised when we were doing her taxes. She got diagnosed with cancer. That's why her 350,000 annual was cut drastically by more than 50% because she has to stop and then go through the chemotherapy. But the good thing, she has the policy that will continuously to cover her rehabilitation, her chemotherapy medication. So that's why life insurance is important. This is not just a product, but this is also an income replacement. Because I know it's emotionally when we get sick, it takes a toll. So how does the cash value in the index universal life? The difference of index universal life, there's a cash value in the IUL that grows based on the interest credited, which is tied to the performance of a chosen stock market index subject to caps and floors. There's always the good thing about IUL, the Index Universal Life, there's always control in the amount of money that you will lose and the amount the money, but at the same time, the company where you enroll, it also control to the amount of money that you can earn. That's why if you're single and then you don't have kids, then I'm not sure if IUL would be ideal for you, but it could be ideal with other that already have pre-existing condition. Because we have a client, he's single and he's healthy, but at the same time he has health problem. So we have to go through all this qualification. If you have health problem, this could also be an applicable product for you more than just but do not think about that money that's gonna grow. It's more about your health protection and also in any terms of sickness and death. Okay, what are the IUL? Can you provide an index universal, or does index universal life provide a guaranteed minimum interest rate? So the IUL compared in the bank, if you're putting money in the bank and then you're putting money to the IUL and you have 100,000 of money in the bank, might as well diversify it because your money will not grow in the bank. It's still going to be there the same. If you put 100,000 there for the past 10 years, guess what? It's still going to be 10,000 on the next years. Somebody talked to me about what about real estate? Yeah, it's good real estate, but you're not liquid. It's not very liquid. So when you need the money and then you don't have rent or you don't have tenants, maintenance, repairs, cash, all of those are not accessible if you have rental property. However, in tax side, it grows the cash accumulation and the you can benefit from depreciation of the house and also maybe the appreciation that it can double the price of the house after 10 years, right? So it's better that you have this other alternative. And I also read Robert Kiyosaki's book, Rich Dad Poor Dad. Real estate is one of the investments that he really recommended. But in the IUL, it provides a guaranteed minimum interest rate, offer a guaranteed interest rate, ensuring that the cash value won't decrease to market losses. The drawback of the index universal loss in their index universal life are their fees with the IUL policies. The answer is yes. IUL policies typically have fees for policy administration, cost of insurance, and potentially surrender charges if the policy is terminated early. The rule of thumb that I always suggest to our clients is make sure that mm, they only put the money that they are willing to part their money on the next 10 years or so. Do not put all your money in one bag, diversify, and then create a budget, meet with your tax professional financial planner every 6 months or maybe once a year, okay? Or before tax season. Now, what is the cap rate of an index universal life policy? The cap rate is the maximum interest rate that the cash value can earn in a given period, limiting the growth even if the index performs exceptionally well. So that's why if you are conservative, this money grows, but it's very conservative. But again, any money that you loan to the policy under the IRC code, Internal Revenue Code 7702, is not subject to tax. Okay, so that's one thing. So people that are asking, can I put money in a 529 plan or versus IUL? If you're sending kids to college, by Index Universal Life might be your alternative rather than 529, because the 529 plans, it has limits. You cannot use it somewhere else. For example, your kids become scholar at the age of 18 and they don't need the money. What are they gonna do with that? Right? They can pass it on to their younger siblings, but again, it's very limited. So might as well might IUL Index Universal Life might be a better option for you than 529 plans in terms of flexibility of the use without being taxed. Okay, I think tomorrow I'm gonna do the rental real estate. Now, strategic planning. How should one prioritize between 401k, IRA, and IUL contributions? Prioritize contributions to 401k plans to capture employer matches, then consider IRS for their tax benefits. So IULs can be used for additional tax advantage, growth, and life insurance needs. So make sure you have protection and then also investment, because even you jump into business, it doesn't mean that your business will gonna make money tomorrow. It can take time for you to be there. Sometimes the first 2 3 years of your business can be losses. So what are the advantages of diversifying retirement savings among 401k, IRA, and IUL? So diversifying provides a balance of tax treatment options, access to different investment opportunities, and multiple income streams in retirement. So you always have, it's like investment or Financial planning is like you have four wheels. That is your car, that is your life, and then you put your family in the car. So there are like four different wheels. The first wheel is your full-time income, the other wheel is your investment income, the other one is savings, the other one is life insurance. But you always have a spare tire, which is at the back of your trunk. So any of these are still moving parts if you're only in the US for the first 5, 10 years, and then you have so many dependents that's why you have that four wheels in the car, and then the spare tire could be your emergency fund, right? Your savings. So that's how you plan. Make sure that you have multiple income streams. Okay. And also, another thing is we are Filipinos or immigrants in general. We have extended family in the Philippines. We send money, medical, because that's just part of the culture. But then again, I mean, sending money to the Philippines or to your loved ones, make sure that you also budget. Learn how to say no, and then do not give the money as soon as they need it. They need to also be educated on how to save and how to invest and do more budgeting. Okay, now, next, what are the benefits of starting to save for retirement early? Starting early allows more time to compound the interest to grow your savings, resulting in a large retirement fund. Invest early because time is with you. Invest early because with the right portfolio, because also you get some tax advantage. And how can one manage risk in a retirement portfolio? So diversify investment across different assets classes, regularly balance the portfolio, and consider including safe interest earning options like bonds or IULs. You can invest in stocks, mutual funds, index universal life, life insurance in general. So that's why every year you want to push more, because I think savings, it's a course of habit. Investment. So for me, when you have an income, this is the budget. This is the formula for a healthy financial planning. You need to have the income minus your investment and savings, then the remaining would be their expenses. Again, so this is your income minus your savings and investment equals your expenses. The other people, they do like paycheck to paycheck. They keep saying, "Oh, we don't have budget," so they have to move to a bigger city because they want to get paid higher. I don't think it's the location. I think it's you that's the problem. You need to know whenever you're making money, investment and savings comes before the expenses. Okay, it's not the other way around. There you go. So we are live again. This is not a financial, legal, or even accounting advice. This is just a public educational purposes only. We just provide some basic idea. Everyone has a case-to-case situation. This is not one size fits all. So what are you waiting for? If you're interested to know more and learn more about your personal financial strategy, your tax strategy, all you have to do is contact us. We need to provide the contact information or scan our QR code to learn more, and then we provide 30-minute free consultation. Thank you, everyone, and that's all for me today. I'm gonna do a lot of editing. Stay safe, and I'll see you tomorrow. I'll do live as much as possible.